Welcome back. Today I'm breaking down 5 stocks I believe are a long-term buy and hold over the next couple years. These are not short-term trades. These are well-run businesses with strong financials, great growth profiles, and then most importantly, moats that will protect these companies for years. I believe each and every one of these companies has the opportunity to outperform the S&P 500 over the long haul. Let's not waste time. Let's dive right into it. Stock number 1 for this month is the same as stock number 1 of last month, Google. As time goes on, we continue to see the narrative around Google change. Just a few months ago, the fear regarding ChatGPT taking away search revenue from Google was out of this world. People really thought the end of Google was near. Well, after another impressive quarter from Google, those narratives are finally starting to turn around. Google reported earnings last week, so let's go over some of these numbers. First off, search revenue grew at an impressive double-digit rate. Looking at this chart, you don't see any disruption anywhere. Through all the negative sentiment, Google has continued to grow their search revenue. AI overview, the way Google is changing their search, has over 2 billion monthly active users now across 200 different countries and 40 different languages. Google CEO also highlighted in this earnings call that YouTube Shorts are now monetizing around the same way that long-form content is. And he even said in some countries, short content is exceeding long-term content. Google Cloud operating margin continues to grow. Over the past year, it's grown over 88%. And now with AI, Google is seeing significant demand increase with cloud computing. Because of this, they're raising their CapEx from $75 billion to $85 billion. I've seen some negativity around this which doesn't make sense. Joseph Carlson explained it like this. If you go to Texas Roadhouse and they say they want to build 50 new restaurants because demand is increasing, in what way would that be seen as negative? A company has to invest more in a certain side of their business because demand is growing. I don't see anything negative around that, and I actually see a lot of positivity in that, just showing how rapidly the Google Cloud is growing. The last thing about quarter 2 I want to highlight for Google is Waymo. I'm going to read off some things that they highlighted in their earnings call. So this quarter, Waymo launched in Atlanta. They doubled their service size in Austin. They expanded LA and San Francisco by over 50%. And then Waymo also launched teen accounts in Phoenix. They have now completed over 100 million miles on public roads. And then they're also testing in over 10 cities this year, including New York and Philly. And as we're starting to see quarter after quarter, a lot of that negativity is slowly starting to disappear. At today's current price, I still believe Google is undervalued and I'm buying this month. The next stock I'm buying this month is Adobe. Adobe, similar to Google, is another company that faces terrible market sentiment because people think AI is taking over their business model. Because of this, they're down over 35% over the past year. To give you the quick rundown, people think not that there's these AI image generators, it is going to make Adobe's Photoshop obsolete. What people don't realize is Adobe relies a lot less on me and you, and they rely a lot more on the thousands of businesses that are tied into their ecosystem. A lot of these AI image generators are not totally accurate yet, and they're also not all commercially safe. So when you have these businesses that need these pixel perfect images that are also commercially safe, you are not going to go on the web and find the cheapest version of an AI image generator. You're going to use the highest quality image generators that Adobe has to complete those tasks. So with all of this, people think Adobe is failing to even use AI. Well, as we look at the numbers, the people that think this is a dying company are far from the truth. This revenue chart is very impressive. Over the past 5 years, they are growing their revenue each year at a 13.41% growth rate. This is a company continuing to grow at very impressive rates, even with all the negative market sentiment. This is also a company on a multi-billion-dollar share buyback program, buying back shares every quarter. And with the stock continuing to get cheaper, they're being able to buy more and more shares, making the shares on the market far more valuable. I recently posted an entire deep dive on Adobe, so if you want to learn a little more why I have such high conviction for this stock, click the box in the corner to watch that video. The next stock is ASML. This is honestly one of the most well-positioned companies I've ever researched. To give you some background on ASML, they create these EUV lithography machines. These machines are responsible for creating the super small patterns on the AI chips that are being made today. What's insane about ASML is they are literally the only company on earth that has found a way to master this. This means that every single AI chip being made had to go through an ASML machine. ASML has 3 direct customers: TSMC, Samsung, and Intel. These 3 companies buy ASML's $400 million machines, and they have to be transported by multiple different cargo airplanes. These are the most advanced and complex machines ever built by mankind. Once these companies have these machines, they literally have to build fabs specifically around these machines. If these companies wanted to buy from another competitor, they would literally have to bulldoze these multi-billion-dollar factories and rebuild them. That's one of the reasons why ASML is so impressive, because the switching costs are insane. And then ASML has so many indirect customers. And then companies like Nvidia, Apple, AMD need these machines to build the AI chips they're building. So that means ASML is exposed to every single chip being made. To me, this is equivalent to selling a shovel during the gold rush. What's so impressive too is people estimate ASML competitors to be almost a full decade behind. You might think eventually a competitor might catch up, but ASML has multi-decade exclusive partnerships with optics legend Carl Zeiss. For a company to catch up, they literally would have to go back in time and create these partnerships before ASML did. And through all of this, the most powerful thing ASML holds is pricing power. Because they are the only company on earth capable of doing this, they can name their own price. These companies have no other option than buying these $400 million machines from ASML. This is a stock down almost 30% from all-time highs, and I'm rapidly buying this month. My last video was a longer breakdown of ASML, so if you want to watch that video, click the link up in this corner. Stock number 4 is Nike. At one point, Nike was down over 60% from all-time highs. Nike is another one of those companies that is absolutely hated by the market. Let me give you a quick rundown of everything that has gone wrong in the past 5 years. In 2020 to 2024, Nike has CEO by the name of John Donahoe. He was an outsider. He had never worked with the company before, and he was actually a former CEO of eBay and ServiceNow. Because of this, he tried to turn Nike into a tech company. One of the main areas that went wrong was he tried going to the direct-to-consumer Nike app way too fast. He started cutting ties with retailers like Dick's Sporting Goods and Foot Locker to try to get more people to buy in the app. What happened as well is they would discount on the Nike app to drive more consumers there. And then what happened for retailers is they would have to discount as well. So at one point they were even. This was the Nike app and this is the retail stores. The Nike app would discount, and for these stores to catch up, they would have to discount as well. And then the Nike app would have to discount, and then they would keep going down, and then it was eventually a race to the bottom, cutting Nike's margins heavily. This not only hurt Nike, but this also hurt the relationship with retailers. Retailers felt abandoned by Nike. While all of this is happening, brands like On Running and Hoka started taking up market share and releasing hot products. So that was the main problem inside the company. And then in 2022, inflation was insanely high. So when you're a company like Nike, a company that sells to the massive, but you're a little more high-end, inflation is going to hurt your market heavy. When inflation is hitting the US heavily, Nike's customers, the masses, are going to pull back on buying the $200 shoes or the $70 sweatshirts that Nike sells. This paired with the poor leadership absolutely tanked Nike's stock price. So then in September 2024, Nike brought in CEO Elliott Hill. He had been with Nike for over 30 years, starting as an intern back in 1988. He was with Phil Knight and the company as Nike became who they are today. Step 1 is performance first. He wants to bring back athlete-driven innovation with tech-forward gear. And then next, you have the retail reconnection. He wants to start rebuilding those relationships that were hurt during 2020 and 2024. Next, he wants to cut discount rates. He wants to end the race to the bottom that are killing Nike's margins. And then you have emotional marketing. So he wants to bring back the storytelling and Nike ads. And then you have local empowerment. He wants to give markets like Asia, Europe, and North America autonomy to adapt quickly. He was able to see the ins and outs of what made Nike great. This is Nike going back into their roots, and this is my 4th stock to buy this month. And stock number 5 is Amazon. I think this is one of the most powerful but misunderstood AI companies in the world. When people think of Amazon, they probably think of e-commerce, Prime, free shipping, or maybe AWS. But what's happening behind the scenes is so much bigger than that. Amazon is quietly becoming an AI and robotics powerhouse. So Amazon's business is built on scale, and scale is expensive. Warehouses, delivery drivers, logistics, this is a massive operation with razor-thin margins. But now, with AI and robotics, they're starting to flip that equation. Today, Amazon has over 750,000 robotics working in their facilities. That's more than one robot for every 2 workers. Every task these robots automate is $1 less spent on labor and $1 more to margins. They are also testing humanoid robotics through a pilot program with Agility Robotics. These robots are going to be in the back of delivery vehicles, jumping out and delivering packages to your door. This might sound small, but when Amazon is doing millions upon millions of deliveries per day, they are going to cut out so many costs of paying workers. Then there's also AI in logistics. Amazon is using machine learning to forecast demand, optimize delivery routes, manage fleet performance, and even predict what products are going to be bought before they're bought. This is how they're planning to cut costs. Similar to Google, with all the AI demand, cloud computing is needed much more than ever in history. Amazon isn't just using AI to run their own business, they're also giving other businesses the tools to use AI. Amazon is one of my biggest holdings and is a company that I'm still buying today. They are one of my core long-term holds. And those are the 5 stocks that I'm buying August 2025. I'd love to hear what you think about these 5 stocks, if there's any stocks you think I missed, or if you disagree with any of my takes. This is a reminder that this is not financial advice, and this is just something that I would do. You should always do your own research before buying a stock. I post other deep dives on this channel as well, including this video right here. So if this video interested you, I would appreciate a like and subscribe, and I hope you come back for another video.